For everybody that's been in the space for a while, the situation seems quite obvious. We have fallen a lot from the top, we are down, and very likely we are not at the bottom of this bear market. But when we dig a bit deeper, things aren't that obvious actually. Over here we've got Bitcoin with one of the best moving averages, the 125-day simple moving average. So we should always buy whenever we are above, we should always sell whenever we are below. This is the backtested data. So buying and holding Bitcoin is in white. Trading according to that moving average is the line in turquoise. This is a logarithmic scale, so there's a 10x from one line to the next. So trading according to that moving average really does much better compared to just buying and holding. And so the situation seems obvious. We should rather still stay cautious. Here's another data point that's rather bearish. This is the stablecoin market cap relative to the US money supply. And during a bull market, we tend to see this simply climbing. So money is flowing into the space. People are converting their hard-earned fiat currency into crypto stablecoins to then speculate with those stablecoins. But since October of last year, this is just going sideways. In other words, we've got the same amount of inflows versus outflows in the market. The market itself isn't expanding, and when no money flows into the system, then it's very hard to see sustainably higher prices, right? Where should the higher prices come from if no capital comes into the space? Another data point that historically worked extremely well to time the bear market bottoms was the net unrealized profit and loss. So the average market participant has to be in net unrealized losses for the selling pressure to ease. So the idea here is relatively straightforward. If we believe in an asset long term, we would not be selling it at a loss. So let's say we did not buy at the perfect price and the price is coming down. We would not necessarily sell that asset if we believe that long term we see a recovery. So nobody would be willing to sell their house at a loss unless they have to sell the house. Most property over the very long term tends to appreciate because the dollar devalues over time. And so a similar parallel could be drawn for crypto as well, as there are still people in profit. As long as the NUPL is still positive, we might still see people taking that profit. And historically, we have only seen the ending of the bear market when we were at net unrealized losses. So when the average Bitcoin investor was in losses, when they saw red in their portfolio, that's usually when it was the best time to buy. But we are not there yet. So it seems like the situation is very straightforward, right? All of those metrics point towards potentially lower prices. This is what most people talk about. When might this turn around? There is the average cost basis of the market. That's currently at $54,000. And historically, at the end of the bear market, we tended to even fall below that price level. So 54K could be a first opportunity to buy for the long term. Now have a look at this, the realized HODL ratio. Now the realized HODL ratio measures how much short-term trading activity there is for Bitcoin versus long-term trading activity. So that's a nice thing about crypto, right? We can have a look at the individual wallets. We know who's buying, who's selling. We've got a lot of transparency with data, and so we can calculate indicators that we can't calculate for any other asset class. When there's a lot of short-term trading, the market is heated. When there's only long-term holders that are currently transacting, then the market is very cool. Now the market is still cooling off, thus prices tend to still go down. And we are not yet in the green area. All of those indicators worked extremely well in the past. Why would we take the risk of buying already at current prices? Here is how the price behaved when we hit all-time highs. How much did we drop from the all-time high after a rally in the past? And the answer is we dropped from the all-time high somewhere between 85 and 75%. We only once had a drop from the all-time high that wasn't all the way to the bottom. That was at the beginning of 2021. So we had a new all-time high. Subsequently, we only dropped from the prior all-time high by roughly 50%. That's where we're currently at. In the vast majority of cases, we see the price contracting much more from the all-time high. And so considering all of those data points, I tend to agree, right? It does look like the bear market is not over and that a 50% drop isn't enough. But there is still something that's worth noting. Yes, there is the 125-day simple moving average, which worked very well for Bitcoin. But there is also the 44-day simple moving average, which historically worked even better than the 125-day simple moving average if we have low trading fees, if we use perpetual futures and not the spot market for trading. Then we move from this backtested result to this backtested result. So it is slightly better using the 44-day simple moving average. And so then the picture isn't that clear anymore. Should we really be bearish? We are extremely close to that moving average now. We might turn around in momentum. We might not need a rally all the way to $84,000 to turn bullish. Maybe just another positive day brings us already in bullish territory. Yes, we do have our fake outs every now and then, and they are painful, but net, if we just follow the shorter term moving average, it tends to time the market slightly better. There's also Ethereum, and Ethereum has just turned bullish. Yes, we had again our fake out, but Ethereum has a shorter best moving average. Its best moving average is over here. It's the 34-day simple moving average. So Ethereum might already turn bullish. It has crossed the best moving average, and the trading range that has been established in the middle of 2022, it might prevail, and we might have a quite solid support here. And so that's the problem. When we look at different data points, we come to different conclusions. It seems like in the short term, things can be more bullish than in the long term. And with the short term, I just mean the next days, maybe weeks. And with long term, I mean the next months. Because both can be true at the same time. We might be rallying in Ethereum for a bit, as we did starting in April of last year, yet the macro still continues to cool down. The long-term holders, they seem to be taking advantage of the current drop. When we look at the long-term holder spending or accumulation, that has actually turned bullish. And the more the price is dropping, the more accumulation we have. And this accumulation trend is going up. So the purchases are speeding up, they are accelerating. Also, the dormant Bitcoin, the Bitcoin that hasn't moved for many years, does not get reactivated anymore. We had a lot of selling when Bitcoin hit new all-time highs. We even had some selling from 126K down to 70K while we were dropping, so the long-term holders were quite bearish. But that has now changed. The value days destroyed multiple, which measures the reactivation of dormant Bitcoin, of Bitcoin that usually doesn't move, that's currently extremely low. So the long-term holders are not going anywhere. They are not depressing the price further. They are not a source of sell pressure right now. Now, we've already looked at the stablecoin market cap relative to the monetary base supply. So that's not growing since October of last year. But instead of just looking at the market cap of the stablecoins, what we can also do is we can look at the market cap of the stablecoins relative to the market cap of all of crypto. So how risk off is currently the crypto space? If the stablecoin dominance is very high, then a lot of capital is just on the sidelines. If the stablecoin dominance is very low, then people are very much deployed. They are risk on. And so while this is the stablecoin market cap, here we've got the stablecoin dominance, and there is an inverse correlation. So at the bottom we've got the Bitcoin price, at the top we've got the stablecoin dominance. When the stablecoin dominance is low, the market is risk on. Bitcoin is very high. When the stablecoin dominance is high, the market is risk off. A lot of capital is just on the sidelines, and crypto prices are low. Now historically, the all-time high for the stablecoin dominance was 16%. And there's two ways to interpret this chart, right? We are not yet at the 16%, so maybe we are not yet at the bear market bottom. But on the other hand, we've shot up that quickly in stablecoin dominance that maybe it's time for a breather. And when stablecoin dominance goes down, that means crypto prices go up. And so this is my base case scenario. The medium-term indicators are somewhat bullish. The long-term indicators are still quite bearish. So we might see a medium-term recovery to then finally get the macro cycle capitulation. And that would bring us below the realized price. We will likely see a lower realized hodl ratio, so less activity in the market. We might even see the stablecoin market cap going down. That's what happened in the prior bear market, right? When Terra Luna and FTX collapsed. And of course, the drawdown from the all-time high might reach again the 70% mark. It seems like from one bear market to the next, the sell-offs are a little bit less extended, but still, even if we draw this line of a decreasing magnitude in the bear markets, we'd still fall from the all-time high by 72% roughly. What does this mean for the Bitcoin price? We topped out at 126K. A 72% drop from that brings us down to 35K. Now those are all just estimates. Nobody knows where the price will go. But in general, I think it's good to just look at the market structure and see what happened in the past. If things developed in a somewhat predictable pattern in the past, it might just become a self-fulfilling prophecy. So there might be nothing fundamentally going on if just enough people look at similar metrics. Then this could potentially turn into reality, right? If enough people just expect that the price goes further down, there will be less demand, there will be less purchases, and there might be more sales. When the price is already historically very low, and people think that we are now very depressed already in the price, we might see first people buying, we might see less selling, and that then becomes a self-fulfilling prophecy. The price will indeed bottom out, just because enough people believed in the prior structure. And so I just bet on the current macro. So even though there might be a relief rally, I'm not trying to time that rally. I'm not trying to buy into that rally. I rather look for short opportunities while the price is going up. When we are in a bull market, I want to buy the dips. When we are in a bear market, I want to short the rallies. That's fundamentally how I go about things. I don't try to bet on falling prices when the market is very hyped up, when the market is hot, when prices tend to go up. The same way, I don't want to bet on rising prices when we are still declining in activity. Still, the majority of investors are in profit after this drop and the market continues to cool down. If you got some value out of this video, feel free to give this a like. Feel free to also check out the premium membership. A link to premium pops up here on the screen. This is where I share what I currently do in this market. Of course, you can also subscribe. I publish videos regularly on this channel. Thanks for watching. See you next time. Cheers.